There's a lot involved with selling your home. There's inspections, there's escrow, there's moving. But once the house sells and the check clears, that should be it, right? Not necessarily. Once tax season rolls around, you could be taxed for the capital gains on your sale. There are some exceptions and it can get a little confusing, so let's clear up what capital gains taxes are and how you can avoid them when selling your home. Can we just bond for a moment over the fact that none of us likes the idea of paying more in taxes? It's not a thing, right? And it's not fun. But selling your home can be fun, and getting a high price for your home is exciting. Unfortunately, depending on how the numbers work out, the IRS and some states may want to cut. A capital gains tax is the fee assessed on profits you make when selling an asset. This asset can include stocks, boats, real estate, and other large taxable assets. You'd be taxed on the difference between what you paid for the asset and what you sell it for. In the real estate world, you could be assessed the capital gains tax in these 6 scenarios. 1, in the 5-year period prior to selling your home, you own the property for less than 2 years. 2, the house was not your primary residence. 3, you are subject to expatriate tax, which is assessed to those who renounce their citizenship. 4, in the 5-year period prior to selling, you didn't live in the home for at least 2 years. 5, you claimed an exclusion on another home in the 2-year period before the sale of this home. 6, you bought the home through a 1031 exchange, meaning you swapped one investment property for another during the past 5 years. The good news is you may be eligible for an exclusion, and your tax filing status will play a big part in how much you can qualify to exclude. If you file as single, the IRS will typically allow you to exclude $250,000 of capital gains on real estate. If you're married, filing jointly, that number jumps up to $500,000. So let's look at this. If you bought a home 10 years ago for $100,000 and sold it today for $500,000, you'd make a profit of $400,000. If you file single on your taxes, $250,000 of your profit wouldn't be subject to the capital gains tax, but $150,000 of it could be if you fall under one of the scenarios I mentioned earlier. If all or portion of your profits from the sale of your home is subject to the capital gains tax, your first step would be to determine what capital gains tax rate applies. The rates are broken down into 2 categories: short-term capital gains tax rates and long-term capital gains tax rates. The short-term rates would apply if you've owned the property for less than a year, in which case the rate is equal to your ordinary tax rate. The long-term rate would typically apply if you have owned the home for over a year. In this case, you'd pay a tax rate anywhere between 0 and 20%, depending on your filing status and income. There are a few ways to avoid paying capital gains on the sale of your house. First of all, keep in mind that the cost basis of your home typically includes what you paid to purchase it, in addition to the improvements you've made to it over the years. This means the more costs you put into the home, the lower your exposure to the capital gains tax may be. Things like remodeling, adding in expansion, landscaping, and more are all improvements that could potentially lower your capital gains tax. Make sure you hang on to the receipts for all major improvements to the property. Most commonly, people avoid paying capital gains taxes by living in the house for at least 2 years. And the 2 years don't even necessarily have to be consecutive. But if you sell a home that you've lived in for less than 2 years, the gains may be taxable. And if it's a house that you've lived in for less than 1 year, it can be even more expensive since you'd be subject to the short-term capital gains tax. The third way to potentially avoid a capital gains tax is by qualifying for an exception. If you sold your home because of work, health, and other unforeseeable events, you might be able to exclude some of the tax. You'll want to check out IRS Publication 523 for the full details. This can be a really exciting time to sell a home. Sellers across the country are cleaning up, y'all. They made an average of $94,092 on the typical sale in 2021, which was up 71% from 2 years ago. Don't let the potential taxes put a dark cloud over what should be the start of an exciting new chapter for you. Just celebrate the victory of making a great profit on the house, use some of the tips I mentioned to lower your potential tax risks, and then pop over to one of our investment articles to learn what to do with all the cash you just made. Taxes can be a little complicated in general sometimes, but to me, the most confusing tax is New York's bagel tax, because if the bagel is whole and unaltered and you take it to go, there's no tax. If it's whole but you eat it in the restaurant, there is a tax. And if the bakery slices it for you, whether you leave or stay, there's a tax.